1, 2, 1.
Hello, and welcome to the ever-changing financial impact of COVID-19 webinar presented by ATKG. My name is Eric Abady, and I'm a partner with ATKG. I have been with the firm for over 10 years and in the industry for over 20. I will be the moderator of today's webinar. Our hour-long presentation is designed to provide you an overview of the numerous changes to the financial landscape due to the coronavirus. Today's presenters are Allison Miller, Senior Manager at ATKG. She's a CPA and a true Aggie. She holds both a bachelor's and master's degree in accounting from Texas A&M. Allison is the director of our Federal Tax Group, and all communications related to COVID-19 have come from her desk. Next, we have David Higginbotham. He's a Senior Manager with ATKG. He's a CPA and holds a bachelor's degree in accounting from UTSA. David serves on the board of directors for the Texas Society of Certified Public Accountants, San Antonio. Our final speaker today will be Diane White. She's also a senior manager with ATKG. Diane is a CPA and holds a bachelor's degree and a master's degree in accounting from the University of Texas at San Antonio. Diane is an active member of the Real Estate Council of San Antonio, ULI, and the current treasurer for CREW San Antonio. Before we get into the presentation, I need to cover a few housekeeping items. Number one, questions are important. We know you have lots of questions and we want to be able to answer them for you. Q&A is available through the Teams application. We believe all questions are important, so please include your name when you submit a question. We will attempt to answer all questions received during our time together, but should we not get to your question before this webinar ends, we will follow up directly if we have your contact information. It's important to put your name on your question so we can get back to you. Number two, this presentation will be uploaded to our website immediately following. You can go to our website and download it, reference it, and review it for parts that you missed. And finally, CPE is available. Please fill out the evaluation form after the presentation and CPE will be provided. We would actually appreciate feedback from all participants. So regardless of needing CPE, we would appreciate your willingness to share the helpfulness of the information we provide today. You will find the evaluation form along with the CPE information in the same confirmation email you used to access our webinar today. The evaluation form will need to be downloaded in order to complete it. I'll go over this again at the end of the presentation. If you have any questions, it'll be revisited. So on with the presentation. The past 6 weeks have seen an unprecedented pandemic wreak havoc on our city, our state, our country, and our world. Our lives have been turned upside down in almost every way. In response to this crisis, we have witnessed extreme and dramatic governmental action. We started to see signs of the major impact COVID-19 would have around the end of February when our economy began to falter. It became apparent that the virus would require the U.S. to have some level of governmental intervention to mitigate the issues presented. On February 24th, the Trump administration asked Congress for $2.5 billion in emergency funding, only $2.5 billion. On March 6th, 2020, Congress approved the Coronavirus Preparedness and Response Supplemental Appropriations Act of 2020. This was the first phase of governmental intervention. This act provided $8.5 billion to combat the spread of COVID-19. Now remember, Congress was asked for $2.5 billion, yet saw fit to provide $8.5 billion. They could see that this was going to need additional funds. March 18th, 2020 saw the next level of relief in the Families First and Coronavirus Response Act. This law provided paid leave, enhanced unemployment benefits, and expanded food assistance for vulnerable children and families. Additionally, the Families First Act provides funds to states for economic assistance due to the pandemic and tax credits to provide business owners relief from the immediate impact of shuttering doors. The largest form of relief came in the form of the CARES Act. On March 27th, we saw the much anticipated passing of the Coronavirus Aid, Relief, and Economic Security Act. This legislation was the third phase of relief provided by the U.S. government to combat the effects of COVID-19. The $2 trillion stimulus package included relief for businesses, individuals, and healthcare in many forms. A few of the key relief provisions are payment to individuals in the form of stimulus checks, government-backed SBA loans through the Payroll Protection Program or Paycheck Protection Program, tax credits, tax deductions, and tax deferrals. The largest component of the CARES Act was the Paycheck Protection Program, or the PPP. It provided $349 billion of financial assistance through governmental loans that can be forgiven. As many of you know, these funds were immediately depleted. The demand on banks to provide information, application assistance, and ultimately funding was intense and liquidated the program in only a few days. On April 16th, the PPP was depleted. The most recent infusion of relief was passed on Friday, April 24th. The Paycheck Protection Program and Healthcare Enhancement Act. This act was exactly what it says, an enhancement to the CARES Act. This was a $484 billion enhancement act primarily to provide additional funds in the amount of $320 billion to the depleted Paycheck Protection Program. This was effectively small business owners' second bite at the apple to hopefully get the funds they need to keep their businesses afloat during this time of financial devastation. In addition to these 4 relief packages, there have been several extensions of deadlines for tax filings and tax payments. On March 16th, Treasury Secretary Steven Mnuchin extended the payment of 2019 taxes due on April 15th to July 15th. As with most things, the relief was somewhat ambiguous and created much confusion. Over the next several days and weeks, further clarification was provided and additional extensions were granted. At the end of the day, tax payments due between April 15th and July 14th were extended to July 15th. Specifically, your 2019 final payments that were due on April 15th, the first quarter ES payments that were due on April 15th, and the second quarter ES payments that were due on June 15th were all extended to July 15th. The majority of the tax filings due between April 15th and July 14th have also been extended to July 15th. This is an automatic extension. This relief applies to all individual returns, trusts, and corporations. Taxpayers do not need to fill out any additional forms or call the IRS to qualify. Second extensions will be required to extend the returns to September 15th or October 15th as applicable. Next, I will pass the presentation over to Allison Miller to discuss payroll tax credits, proper use of the funds, and the appropriate documentation required to support forgiveness of loans made under the PPP. Thank you.
Thank you, Eric. One of the most impactful programs Congress implemented to combat the effects of COVID-19 on businesses is undoubtedly the Paycheck Protection Program, or PPP, which was passed as part of the CARES Act on March 27th, which seems like a lifetime ago to me. The program originally authorized $349 billion in forgivable loans to small businesses to pay their employees during the COVID-19 crisis. The SBA made it quite clear that the focus of this program is to keep employees on the payroll, which is why the loan proceeds must be used mainly for payroll costs, while only a small percentage of the loan may be used for specific authorized expenses, which we'll get into in a few slides. I think it's fair to say Treasury was not as concerned with the other expenses small businesses were facing, notably rent expense, despite how significant these costs can be. By far, the Paycheck Protection Program is what ATKG has received the most questions on this past month. Initially, as we assisted our clients with completing their PPP applications, the questions were mainly on how to calculate average monthly payroll. Guidance was slow to be released, and so we saw a myriad of calculation methods at first. Business owners, bankers, and CPAs desperately tried to stay on top of the ever-changing PPP guidance. I will tell you, it was definitely a struggle for all of us. Some of the terms in the original CARES Act were significantly different when the SBA finally released guidance. For example, the PPP loans were supposed to be 10 years at a 4% interest rate, and once we received SBA guidance, the loans were suddenly 2 years at a 1% interest rate, and that's just one example of many. It felt like the rules were changing by the hour, and it was unbelievably frustrating, and it all came to a halt on April 16th when the original PPP funding was totally depleted. Through April 16th, the SBA had guaranteed over 1.6 million PPP loans, with about 135,000 of them right here in Texas. I've heard the SBA say they processed 14 years of loans in 14 days. But as we all know, many small businesses were not able to get the funds they applied for, and in response, Congress passed $310 billion in more funding with a new stimulus package that President Trump signed into law almost a week ago on Friday, April 24th. The SBA reopened the application process this past Monday morning, and not surprisingly, the SBA website crashed almost immediately. As far as I can tell, there is still funding in the PPP program. I've had a few clients that were unable to get funding in the first round of PPP loans and have had their applications approved this week. Hopefully, those of you that didn't get PPP loans in that first run are getting good news this week as well. What has been in the news the last few days, as I'm sure you've seen, there's been a lot of pushback on several publicly traded companies, notably large restaurant chains such as Shake Shack, Ruth Chris, and Potbelly, who all received large PPP loans and after much pressure have promised to return those loans. I even saw that the LA Lakers qualified for and received a PPP loan, but they are returning it likely because of the bad publicity they are receiving. To be fair, it should be noted that the CARES Act suspended the ordinary SBA requirement that borrowers must be unable to obtain credit elsewhere. However, the PPP application form requires applicants to certify in good faith that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Treasury Secretary Steve Mnuchin has since said that the PPP was not intended for large companies with access to capital, either public or private, even if they meet the PPP requirements. So companies have until May 7th to repay any PPP loans that the borrower obtained, quote, on a misunderstanding or misapplication of the required certification standard. For most small businesses, I think the current economic environment provides substantial basis for uncertainty, but with that said, you should be prepared to substantiate your loan request. I've heard the government say that they're going to look at applications in which a PPP of more than $2 million was approved. Next slide. Once most of our clients began to receive their PPP loans, the questions we received started to focus on the loan forgiveness aspect of the program. The SBA has promised us multiple times specific guidance on the loan forgiveness, and I was hoping we'd have it before our webinar today, but we don't. So there is a lot of gray that you'll see in the next few slides. At a high level, at least 75% of the loan proceeds must be used for payroll costs, and the remaining amount can be used for mortgage interest, rent, and utilities. The amount you submit for forgiveness must also follow the same ratio. That is, at least 75% must be comprised of payroll costs. This is another thing that changed. When the initial CARES Act was signed into law, the parameter regarding the 75% of payroll costs was not there. And many businesses applied for loans thinking that they'd be able to use the PPP to help them survive until businesses could be reopened. Once SBA guidance started to roll in, we first learned that whatever you submit for forgiveness must be at least 75% of payroll. Then we found out that the entire loan proceeds must follow those same rules, where at least 75% must be payroll. The loan will be fully forgiven if the loan proceeds are spent within 8 weeks and are used for specific authorized expenses, which are the mortgage, interest, rent, and utilities. And that 8-week period that starts on the day you receive your PPP loan disbursement is called the covered period. Since so much of the loan must be spent on payroll costs, I thought it'd be a good idea to spend a few minutes on what payroll costs are and are not. So payroll costs include the salary or wages for each of your employees, including payments for vacation and sick leave, employee benefits such as group healthcare coverage, retirement contributions, and state unemployment payments. Payroll costs do not include employee compensation in excess of an annual salary of $100,000 prorated for the covered period, federal employment taxes, and qualified sick and family leave wages for which a credit is allowed under the Families First Coronavirus Response Act, which we'll get into later when we talk about payroll tax credits. So if you prorate $100,000 for an 8-week period, that means you cannot pay any employee more than $15,385 during the covered period. This works out to about $3,800 for a 2-week pay period. On top of that, you can add those allowable benefits, healthcare, retirement, etc. There's something else I want to point out. Remember, when you applied for your PPP loan, you took your average monthly payroll and multiplied it by 2.5, meaning your loan amount was equal to 10 weeks of payroll. Well, the forgiveness period is only 8 weeks, so you'll likely have more money than you need for 8 weeks of payroll, and you'll have to decide how to spend the excess funds. You'll either have to spend it on other authorized expenses, or you might decide to pay bonuses, or you can spend it on payroll after the 8 weeks is over, which means that that portion won't be eligible for forgiveness. Any amounts that are not forgiven are treated as a 2-year loan at a 1% interest rate. Keep in mind, though, that any amounts treated as a loan can still only be spent on authorized expenses and must still follow that same 75-25% parameter. Next slide. One of the biggest caveats for the PPP is that forgiveness is based on the employer maintaining its pre-pandemic headcount and salary levels. If the number of employees declines or salary levels decrease, the amount of forgiveness will be reduced. Again, we're waiting on guidance from the SBA, and we don't have that yet, so there is a lot of gray area that you'll see, but here's what we do know. When I talk about employee headcount, I'm specifically referring to the number of full-time equivalent employees that you have, and the amount that you have eligible for forgiveness will be reduced if your full-time equivalence is less than it was before the pandemic began. So in this formula that you see on the screen, you first have to take your tentative forgiveness amount, which is what we talked about on the prior slide. You have to make sure that what you're submitting for forgiveness is at least 75% payroll. And then once you have that, you're going to multiply it by this full-time equivalent ratio. So before I explain what that ratio means, let's dig into what a full-time equivalent is. The CARES Act did not define this for us, but a Treasury FAQ that was released a few days ago stated that for purposes of loan forgiveness, we should use the standard definition of full-time equivalent employees. It didn't provide us that definition, it simply told us that's what we should use. I've done a lot of reading this week, and most of the experts seem to agree that the SBA will likely use the definition of a full-time equivalent as defined by the Affordable Care Act years ago. The ACA definition of a full-time equivalent is calculated by taking the total hours worked by part-time employees in a week and dividing it by 30 hours. The ACA considered 30 hours in 1 week to be a full-time employee, even though most of us consider 40 hours to be a full-time employee. In terms of record keeping, it would be nice if the SBA used this definition, since many payroll platforms can already calculate this number due to ACA reporting. So once you know what your full-time equivalent is, once we have that definition, you're going to have to calculate your full-time equivalents at multiple points in time for purposes of this loan forgiveness calculation. So again, in this ratio that you're going to multiply by your tentative forgiveness amount, the numerator is your full-time equivalents during the covered period, which remember, this is an 8-week period starting the day you receive your PPP loan disbursement. And the denominator is your average pre-pandemic full-time equivalents, which can be calculated in one of two ways at the employer's discretion. Your first option is to use the average number of full-time equivalents from last year, from 2019, specifically between February 15th and June 30th of 2019. And your second option is to use the average number of full-time equivalents between January 1st of 2020 and February 29th of 2020. You would want to choose whichever option is smaller, so your ratio is as large as possible, which in effect makes your adjusted amount eligible for forgiveness as large as possible. There are a few things up in the air. For starters, as I mentioned, we are guessing on the definition of a full-time equivalent. We also don't know the implications of hiring replacements to fill empty spots. I've had some clients ask me if they can hire family members to fill empty spots or temporary workers, and I don't know the answer to that yet. Lastly, many businesses in the state of Texas cannot open yet. Starting tomorrow, May 1st, it's a big day. I can't believe it's May, first of all, but tomorrow's a big day because some businesses such as restaurants, retail, movie theaters, malls, and museums can open at 25% capacity. So if you're a business that already received a PPP loan using your average 2019 payroll as the multiplier, your PPP loan is likely larger than what you can spend it on payroll in the next 8 weeks. This means that you likely won't be forgiven on 100% of your PPP loan proceeds. Next slide. In addition to worrying about employee headcount, you also have to consider salary reduction. Loan forgiveness will also be reduced if your salary or wage levels drop. This rule only applies to employees that made less than $100,000 in 2019, and for each of those employees, you'd have to compare their salary during the covered period to their salary during the prior full quarter before the covered period started, which for most businesses will be the first quarter of 2019. So again, for employees that made $100,000 or less, you're going to have to compare the salary in the covered period to the salary in the first quarter of 2020. In that comparison, if the employee's salary from the prior quarter was reduced by more than 25%, your loan forgiveness amount will be reduced. For example, if an employee earned $100,000 in 2019 and during the first quarter of 2020 also made the prorated salary of $100,000, you can drop their salary level to $75,000 during the covered period without forfeiting forgiveness. However, if you drop their salary below $75,000, you will have to reduce your loan forgiveness amount by the difference between the $75,000 and whatever you reduce their salary to. There are a lot of unanswered questions here as well. First of all, we don't really know what we should be comparing. Are we comparing average weekly pay in the covered period to average weekly pay in the first quarter, average hourly pay, or something else? It surely cannot be a pure dollar amount because you'd be comparing 8 weeks of pay in the covered period to 12 weeks of pay in the prior quarter. If you cannot hire an employee, maybe that employee went on unemployment and they don't want to come back, or another reason, his or her salary reduction is technically 100%, which is obviously greater than 25%. So what happens in that instance? Do you have to reduce your loan forgiveness amount for that particular employee's salary? Also, if you hire an employee, a new employee, to fill a former employee's spot, what salary figure should you use for the prior full quarter? At this point, I'm sorry to tell you that we just don't have the answers. Next slide. What I do have right now are just some general recommendations. And the biggest piece of advice that I have is to actively manage your PPP loan proceeds. If possible, the loan proceeds should be deposited into a separate account so it doesn't get commingled with your other funds. I think this would be the cleanest way of showing what you spent the PPP loan proceeds on and increase your chances of having your loan forgiveness request approved. I've had several clients where they are transferring money from their PPP loan account to their normal checking account for authorized expenses, and that seems to be working pretty well. You should be working with your CPA, hopefully that's us, to make sure you are following those guidelines about 75% versus 25%, And as you saw, the payroll cost calculation can be tricky, so it's important that you work the numbers. Depending on how often you pay your employees, you may only have a few payroll cycles to get 75% of your PPP loan paid during the 8-week period. And lastly, document. We know the SBA will require you to submit quarterly payroll reports, copies of checks and invoices, utility bills. I've even seen that a narrative may be due. However, we're still waiting on specific guidance, so we just recommend that you pull together all the documentation that you can. And of course, ATKG is on top of the changing news, and when we get new updates or more guidance, we will share that through our email blasts and on our website. And I don't think it's too early to talk about what lessons we have learned over the last month. And the biggest one for me has been this. Despite the SBA stating that these loans will be issued on a first-come, first-served basis, many banks prioritize certain applications, as evidenced by the recent lawsuits served to Bank of America, Wells Fargo, and JP Morgan Chase. These lawsuits claim that banks prioritized larger loans instead of processing the PPP applications in the order they were submitted. Many banks prioritize the application of their existing customers, which inevitably means they did not process applications in the order they received them. While reasonable, this practice undoubtedly created inconsistencies in the application process. One thing I've learned from this experience is that having a close relationship with your banker is extremely important, especially in times of crisis. I wouldn't be surprised to see some of my clients change banks when this is all said and done. Moreover, because of the complex rules regarding payroll costs and the tracking of loan forgiveness, having a close relationship with your CPA is also important. Helping our clients with their PPP applications and loan forgiveness tracking has been ATKG's #1 priority these last several weeks. Next slide. We're going to transition to a different topic now, payroll tax credits. Although the Paycheck Protection Program has garnered the most attention in recent weeks, it's not the only thing Congress implemented to help businesses. They also introduced a couple new payroll tax credits. The first one is known as the Emergency Sick and Family Leave Tax Credit. An employer that pays emergency sick and family leave to employees for COVID-19 can claim a refundable tax credit equal to the amount of the paid leave through December 31st, 2020. This credit can still be claimed even if a business receives a PPP loan, but you cannot include the sick and family leave wages in your payroll cost calculation to obtain the loan or in the amount in which you request forgiveness on. A second credit is the Employee Retention Credit, which is a credit that employers can claim if a business was fully or partially suspended or if gross receipts significantly declined as a result of the COVID pandemic. The credit equals 50% of qualified wages paid to employees between March 12, 2020 and December 31st, 2020. The maximum wages eligible for the credit are $10,000 per employee, which means that eligible employers can claim a maximum credit of $5,000 per employee, which is a lot of money. The receipt of a PPP loan, though, makes your business ineligible to claim the Employee Retention Credit, even if no portion of the PPP loan is forgiven. You can, however, claim both the Employee Retention Credit and the tax credit for the emergency sick and family leave that I just discussed. You just have to make sure the credits are not for the same wages. You cannot double dip. Furthermore, for those two credits, a business can file IRS Form 7200, which allows you to estimate the amount of the credits and receive them earlier than if you waited until your quarterly payroll reports are due. Next slide. Another option Congress gave us was the deferral of the employer share of Social Security tax that would be due on wages from the period beginning March 27 through December 31st, 2020. The deferred employment tax must be repaid over 2 years in 2021 and 2022. No special election is required by the business to take this deferral option. I just strongly urge you to not lose track of it because payroll taxes is definitely something you don't want to mess with. And per the IRS, the quarterly Form 941 due for the second quarter is being revised to account for any deferred taxes. So what happens if you started deferring taxes on March 27th, and then you found out that your PPP application was accepted? Well, an employer who receives a PPP loan, but whose loan has not yet been forgiven, may defer through the date the lender issues a decision to forgive the loan. Once an employer receives the decision from its lender to forgive the PPP loan, it is no longer eligible to defer. And the last thing I want to mention on credits, and it's not on the slide, is the Work Opportunity Tax Credit, which has been around for several years. And the Work Opportunity Tax Credit, or WOTC for short, is a credit available to employers for hiring people in specific targeted groups, like those on long-term unemployment benefits, veterans, ex-felons. There's several categories. And for each new employee that you hire that qualifies for the WOTC credit, you can get a credit on your personal return anywhere from $1,200 to $9,600 per employee. The only kicker is you have a narrow window of 28 days to submit the required forms to the Texas Workforce Commission. You cannot claim the credit if you're hiring a former employee, but you can definitely claim the credit for any new employees that you hire that qualify under one of these targeted groups. It's just a couple of forms that the new employee needs to complete, and you file those with the Texas Workforce Commission, and the TWC would tell you whether they qualified or not. So don't forget about that credit, because it could provide you real benefit at the end of the year. So as you can tell, despite their bickering and extensive negotiations, Congress did manage to pass several provisions to help struggling businesses. The rules are quite complicated, so we urge you to work with your CPA, banker, and payroll provider to ensure your business is taking advantage of what is available. Congress also passed some helpful tax provisions, so I'm going to pass this virtual baton to my colleague, David Higginbotham.
Thank you, Allison. I know the PPP loan and payroll tax provisions have been on everyone's mind and a hot topic of recent news, so I'm glad that we were able to cover those. But those weren't the only provisions included in the recent acts. There were some additional items that have not been receiving quite as much attention, but can have a significant impact nonetheless, and those were the temporary and permanent changes that were included in the act. So I'm going to be discussing qualified improvement property, changes to the net operating loss and excess business loss rules, and then we'll be passing it to Diane to go over some additional tax law changes and qualified disaster relief payments. All right, so starting with qualified improvement property. Some of you may have heard of qualified improvement property. It's not new. This wasn't something that came about with the CARES Act. This was just something that was already in place previous to that. It was implemented in 2015 with the PATH Act. And what this was, it was an additional category of property which went along with other categories of property that were already in place to give you preferred treatment on certain improvements and buildings. And those were the qualified leasehold improvement property, your qualified retail property, and qualified restaurant property. So qualified improvement property in particular, it applies to improvements to the interior of the building, and these are improvements after your property has already been put in place into service. So improvements to the interior of the building that are not attributable to the enlargement of the building, that's enlarging the shell of the building, increasing the volume. You're not expanding outward, you're not expanding down, you're not adding stories or expanding upward. You're not increasing your shell. Any of those, any improvements that increase the shell aren't considered for this qualified improvement property. You don't get to improve your elevators or escalators under qualified improvement property. Those are not included. And then you also, you don't get, it does not apply to any internal structural framework. That could be structural beams or other framework within the building, within the interior of the building that supports the overall structure of the building. So what this qualified improvement property allowed when it was originally implemented in 2015 is it allowed you to treat 39-year property and make it eligible for bonus depreciation. So, fast forward to the Tax Cuts and Jobs Act that we just implemented in 2018. we saw implemented in the 2018 tax year. They basically got rid of the three other improvement properties: the qualified leasehold, qualified retail property, and qualified restaurant property, and left us only with the qualified improvement property. However, when they went through and they got rid of these other three properties, they created a drafting error, which removed the bonus depreciation eligibility for the qualified improvement property, basically leaving us with 39-year improvements, which nobody wanted. It was definitely an error. It was something that we saw after the fact, after this bill was signed into law, and it only allowed in some certain instances for this property for interior improvements to be eligible for 179 deduction. So if we remember correctly, the Tax Cuts and Jobs Act, it was signed into law in December 22nd of 2017. So we've been waiting for over 2 years for this change. Last year there were several bills that were coming through that we thought this might be tagged onto to correct this error, and it never seemed to make it through until this last recent legislation with the CARES Act. So what does the CARES Act do? It came in and it corrected the drafting error. And the way that they did that was they dropped the asset life for qualified improvement property down to 15 years. And by doing that, it makes it eligible for bonus depreciation. And so the key piece here is this was done retroactively. This was done as if the error was never made in the first place. So this allows you to go back to your 2018 tax year and to make corrections for any of those qualified improvement assets that you may have been depreciating for 39 years starting in 2018. You can actually go back and do a correction of that year to bring it to 15 year and to catch up on the depreciation there. And this is really important because if you remember correctly, 179 deduction, it's you have certain income limitations with taking the 179 deduction. So even if you took 179 deduction in 2018, you're limited to your net income. So you're not able to create an NOL with 179. Bonus depreciation is different though. Bonus depreciation, it allows you to go beyond your net income and create NOLs. And the other thing is, you've already paid tax for 2018. This is changes that can be made in 2018 that create benefit now. You actually can get refunds for those payments that you've already made, and you'll see that as kind of a reoccurring theme of what happened here with the CARES Act. They're really trying to get us back into those tax periods where you may have already paid taxes and you're able to reap some benefits and create some refunds. So it's an additional way IRS can get money back to you and to help the businesses and individuals. So with this qualified improvement, with these changes, you're creating extra deductions. And in 2020, many businesses are experiencing, increased losses. And may potentially be seeing some net operating losses. And so now we're going to go ahead and talk about some of the changes that occurred with the net operating loss rules. So again in 2018, at the end of 2017, the Tax Cuts and Jobs Act, they changed our NOL rules. The previous NOL rules prior to Tax Cuts and Jobs Act, they allowed for a carryback, which was varied depending on whether you're a corporation or an individual, and then it had a limited carry forward period for individuals. That carry forward period was 20 years, and then after that you started to lose. You weren't able to carry forward beyond that. So the Tax Cuts and Jobs Act basically removed your carry back rules. You weren't allowed to carry any NOLs back, and you were only allowed to carry forward, but they removed that limitation, so you were allowed to carry forward indefinitely. But the caveat there was they also imposed an 80% of taxable income limitation for those NOL carry forward. So if you were carrying forward an NOL into a profitable year, you were never going to be able to offset 100% of your taxable income for that year with an NOL. You were always going to have something left on the table, and you were going to have an NOL that would continue to carry forward. So the changes that the CARES Act provides for the NOLs is that they remove, they actually allow you to carry back. So they remove the 80% rule. So you're allowed to, you don't have to worry about how how these NOLs will be applied. If you don't have to worry about the income limitations of these NOLs, and you're allowed to carry them back for 5 years now. Also, within the TCJA, there was some repatriation of foreign income that was done as well under those tax laws. So these NOL provisions where we're going back 5 years, we don't get to apply any of the NOL to any of that repatriated income. It's calculated separately. Also, if you don't have any, say you've been operating pretty close to NOLs, or you don't have a large amount of benefit in prior years of that 5 years that are covered, you can also make an election to forego that carryback period. And in doing that, you get to go, you can forego that carryback period, and you can make that election on any of your 2018 and 2019 if you've already filed those returns on your next timely filed return. The deadline for filing the carryback tax adjustment for 2018 is June 30th, 2020. So we need to be looking at those 2018 returns and looking at any NOLs that may have been available there, or additional deductions that were created using the qualified improvement property changes, to make sure that we get those made and addressed before this June 30th deadline for that 2018 period. And so why is this important? So again, this is creating potential losses. This is creating potential losses in prior years that we're able to carry forward to this year to reap the benefits now. So the big thing, and if you remember correctly, before the TCJA, we were at a 39.6% as the highest individual tax bracket. So the tax brackets were a lot less friendly back then, and we're in friendlier times with tax brackets now. So we're not as high of limitations there, but we're allowed to, if we carry back into those previous years, we can reap benefits at those higher tax brackets and get more potential tax dollars back from those periods. And so again, with the net operating losses, there was also a piece of the TCJA that capped your losses available for your businesses. And so that was the excess business loss limitation. And what this basically implemented here is that you were only allowed up to $500,000 loss with your business losses. So if you had business losses in excess of 500,000, and this is only business losses. So you were actually limited on those, and you weren't able to carry them back. They were treated as a carry forward into future tax periods. And basically this CARES Act, what it does is it removes that. It pretends like this law wasn't enacted, and it gives us until 2021 until this is put into place. So that allows you, for all of the NOLs that you're creating now in 2020, or any of these provisions that we're going back and changing for prior periods, to create, if you had losses in excess of these amounts, so it doesn't impact, how much NOL you can create. And and carry back to those prior years. All right, so that was a lot. It's, there's a lot of changes going on within the tax law, and just remember these have been changing rapidly as we go. And the big thing here is, what can we get back and get refunded on now to keep us going? And so those are all things that we're looking into as we're preparing 2019 tax returns, and as we're looking at 2020 to see what NOLs and different provisions we can apply there. So I'm going to pass it over to Diane, and she's going to cover some other tax law changes and provisions already available to help businesses. Thank you.
Thank you, David. And I'm going to walk through two topics with you today, one of which has been amended as part of the CARES Act and the legislation recently passed, and one is already in place, but something we should take into consideration due to the current environment that we are in. So first of which is the business interest limitation. That's Code Section 163J of the tax code, and this was something that we saw for the very first time in 2017 when the Tax Cut and Jobs Act was imposed. And what it essentially did was create a limitation of interest expense that taxpayers could deduct on their tax returns. Now, there is have ability for certain taxpayers to not be subject to this limitation, but with that being said, we did see quite a handful of our clients that are subject to the limitation, and for those who have debt financing and incur a lot of interest expense in their business as according to normal industry standards, this could have significant impact to their tax deductions. So what the Tax Cut and Jobs Act did originally was they said that you, taxpayer, are limited to 30% of your adjusted taxable income to be able to deduct business interest expense. So the code section is quite extensive, so I'm going to speak very high level. Essentially, adjusted taxable income is very similar to taxpayers' EBITDA. So that is earnings before interest, taxes, depreciation, and amortization. Well, as David mentioned, the CARES Act amended this code section, and in their attempt to try to get more deductions to taxpayers to help with the burden many have been facing. And they have taken for 2019 and 2020 and taken this limitation and increased that percentage from 30% to 50%. Now, there is a special rule for partnerships, which I know many taxpayers are in forms of partnerships, that limitation does not come, the increase does not come into effect until the year 2020. Now, this limitation does apply at the entity level, and then if it passes through, if you're in a pass-through, does apply at the individual level as well. So partners individually still are allowed to take that increase from 30% to 50% in 2019. So what that means is there's just going to be a lot more calculations needed if you are subject to that rule, and hopefully we'll be able to get you some sort of additional expenses for those tax years. So as many people are facing some financial uncertainties, the Congress definitely foresee, as I know many of us, that our income for 2020 will probably be lower than 2019. And one other amendment they did in this code section is they are allowing us to use our 2019 ATI, adjusted taxable income, to calculate our 2020 business interest limitation. So that, again, is in hopes that we are able to take more deductions in that tax year and will relieve some of that tax burden on taxpayers. Now, if for some reason, for planning purposes, this increased limitation is not beneficial to a taxpayer, they can elect out of that increase and keep it remaining at that 30%. So really, a lot of these legislative changes that David mentioned, this coupled with what he said, provide us a unique opportunity to do some planning and structuring around various taxpayer situations. So we highly encourage you to reach out to your CPA and see how these items specifically affect you and what best options we have going forward. So the next thing I would like to talk to you, while it's not something that is new, it is something that is apparent right now because of our current environment. And those are qualified disaster relief payments. So that is Code Section 139 of the tax code. And this comes about when there is a declaration of a national emergency, which we are in currently. And typically employers can't gift their employees money. But under this code section, we are able to provide the employees with non-taxable financial assistance while still being able to take the deduction on the employer end. So essentially a win-win opportunity for both. And there are specific things that we can help the employees to get reimbursed for. And the code section gives the description that the expenses must be reasonable and necessary personal, family, living, or funeral expenses that were incurred because of this virus. So that's kind of very general. So we thought we would walk you through some examples of what could be reimbursable versus what we think are not reimbursable. So reimbursable expenses, according to this code section, to receive that non-taxable financial assistance could be unreimbursed medical expenses. These are copays, deductibles, medication that the employee may incur that you're allowed to provide some assistance for. Another option is expenses incurred as part of setting up a home office. Many of us have become working remotely 100% and have had to modify our homes to be able to do so. And so you are allowed to provide assistance to your employees for that kind of cost. And those are furniture and chairs and computers and printers and maybe even some increased internet charges. Additionally, you're able to provide assistance for increased housing costs due to being quarantined at home. So utilities, I'm guessing for many, are going up because you are now home 100%, and those are something you can help reimburse your employees for. Finally, there are many of us who have our children home because the schools are closed, and that may mean that you have to have some sort of increased child care expenses. Employers can provide non-taxable financial assistance to their employees for that cost. Now, some things that are not reimbursable under this code section is payments that are considered income replacement. So essentially lost wages. Those are something that you are not allowed to provide non-taxable financial assistance for. Payments that are reimbursed or reimbursable by insurance policies, those are not covered under this section. And then payments, again, that are not reasonable or necessary, so anything extraordinary that you maybe would not consider reasonable or necessary are not covered under this section. So some considerations if you do decide to do some qualified disaster relief payments as an employer that you want to take into account. So employees do not have to substantiate the expenses to the employer. So they don't have to provide you receipts according to this code section. It's almost a good faith that whatever they're saying they've incurred, they actually have incurred and is an eligible reimbursement. There is no dollar limitation that you can provide employees, nor is there a deduction limitation that you as an employer can deduct on your return. Again, this is not taxable, so it's not included in any payroll tax filings or any other filings of that manner. And so while there is no requirement according to the IRS to have a documentation of this plan in place, there probably is a good idea, and what we're recommending is to have something in place. And so that may come in the form of some sort of application form that your employee can fill out that confirms that those are reimbursable expenses and they do meet the requirements listed above. Again, this is an opportunity to give employees non-taxable financial assistance, and then you as an employer get the deduction. So win-win. Finally, I'm going to hand it over to Eric to wrap up our webinar for the day.
Thank you, Diane. Thank you also to Allison and David for your presentations. One thing that is abundantly clear is that there are a lot of moving pieces with these changes, with the virus that is impacting our financial well-being and impacting the way we run our businesses and impacting the world around us. So seek out guidance from the professionals, talk to your CPAs, talk to your bankers, talk to your attorneys, and they will help you get to the answers that you need to be successful in this environment. Thank you to all of you that participated and watched the presentation. We really appreciate your time for this past hour. Thank you to Peyton and Christina and Maria behind the scenes, our producers that put all this together and helped us be successful today. As we close, there's information on the left-hand side of your screen. The evaluation should be returned to marketing@atkgcpa.com. That is for CPE as well as for feedback. We like all feedback. After this presentation, it will be uploaded to our website. You can visit it and see the page ATKG Coronavirus Newsroom. That has all of our updates and all of the information that we've put out since this started 6 to 7 weeks ago. For further information on anything that we've done today or talked about today, please call our office, 210-733-6611, or send an email to the office at atkgcpa.com, and we will get back with you as soon as possible. Thank you again for being part of this webinar, and we look forward to doing more of these in the future. So we will see you then. Thank you. Bye-bye.